Most important thing is to be able to define which ones you can come to an intelligent decision on and which ones are beyond your capacity to evaluate.
And I think we're all interested in our limits, what we can accomplish in life, and discovering our own limits. And we might find that in sport, we might find that in business. I think we're always looking to discover new things, and new things about each other and new things about ourselves.
Welcome back, Wealth Tubers. The big question on every investor's mind: will the stock market crash in 2025? Today, we're breaking down 8 major risk factors that could shake the markets. From interest rates to AI bubbles, we've got it all covered. Let's dive into the risks that could make or break your portfolio in 2025. The U.S. stock market swung between volatility and chaos as the Nasdaq, and artificial intelligence and semiconductor stocks in particular, plunged amid news that a potentially cheaper and more efficient China-based AI model called DeepSeek had launched. The Nasdaq Composite Index dropped 3.1%, while Magnificent Seven stalwart NVIDIA Corporation shed 17% of its share price and lost about $600 billion in value, breaking the record for a one-day loss by a U.S. company. NVIDIA stock did rally the next day as retail buyers bought the dip. NVIDIA shares ended the day up 8.9%, and the Nasdaq gained 2%. Wall Street analysts say that one way or another, the technology bubble burst, and the DeepSeek news gave sector investors a reason to shed portfolio shares. With the current S&P draw-up already exceeding 30% and valuations approaching stretched levels, history suggests it's too late to avoid a bust at this point. The tech stock drain leaves the stock market in a precarious position. Investors must wonder how much risk remains with artificial intelligence stocks, while also wondering if they'll miss out on any significant rebound. Will the market fall into chaos or stabilize quickly? Here are the factors that will dictate whether it crashes or not in 2025.
A top-heavy market.
As the DeepSeek triggered sell-off revealed, the market got away with a handful of stocks, notably those Magnificent Seven stocks, generating outsized performance in 2024 and early 2025. Those 7 stocks, Apple, NVIDIA, Microsoft, Amazon, Alphabet, Meta Platforms, and Tesla, recorded more than a 60% average gain in 2024. The Magnificent Seven was responsible for more than half of the S&P 500's performance in 2024. Tech overconcentration is a risk factor. A select few stocks have driven the majority of market gains, so the market is vulnerable to any disruption.
International competition.
Related to DeepSeek's emergence are concerns that there's a threat to U.S. supremacy as an AI superpower. DeepSeek's efficiency with fewer resources challenges U.S. AI leadership. That could have long-term implications for tech companies' revenue and investments. As the relationship between the U.S. and China has deteriorated, semiconductors have become entrenched in every aspect of daily life, from smartphones to energy to defense technologies. Since semiconductors support AI in many applications, dominance in this area will play a key role in economic growth, technological development, and national security.
The Fed and interest rates.
Another key risk factor is how the Federal Reserve handles interest rates. The Fed paused interest rate cuts at its policy meeting on January 29th, and traders don't expect another cut until May or June. They initially evaluated inflation as transitory, but it's proven to be sticky. The Fed tends to take a wait-and-see approach when raising or lowering interest rates. New economic investments should lead to a stable job market, and if government spending slows down, that could also be a positive sign for the markets.
Waning consumer confidence.
When shoppers snap their wallets shut, that's bad news for the stock market. Consumer confidence impacts spending, which is crucial for corporate earnings, which tracks over $70 billion in consumer spending across the U.S., currently sees spending down across every shopping category in retail, travel, consumer discretionary, leisure, and oil and gas this year compared to last year.
Government overspending.
Stock valuations may be high, but there's an even bigger problem in play: a budget-busting U.S. government spending habit. According to data from the U.S. Congressional Budget Office, the federal government is staring down a $1.9 trillion deficit for fiscal year 2025. The CBO notes that that's about 6.2% of the U.S. gross domestic product. That's significantly more than the 3.8% that deficits have averaged over the past 50 years. Currently, Uncle Sam is spending more cash than it collects, a scenario that could lead to foreign U.S. Treasury buyers demanding higher interest rates when purchasing American bonds. The situation likely isn't abating, as the CBO estimates the deficit will rise to $2.7 trillion by 2035.
Stubborn inflation.
New inflation numbers in the United States have been released this morning. Those numbers, of course, always have the potential to move markets. This morning, investors have learned that U.S. inflation ran hotter in January than economists had expected.
The U.S. economy is solid right now, with GDP growth at 3.1% and an unemployment rate of 4.1%. But in economics, looks can be deceiving. The biggest issue is inflation running high at 2.9%. Which will delay rate cuts along with uncertainty about how the oncoming trade wars will play out. Moreover, deportation threats, which have already hit the agriculture sector, further increase the risk of higher U.S. inflation.
Economic imbalance.
A co-chief investment officer at a capital management firm in Indianapolis sees market risks in two key areas in 2025. Risks to the stock market in the short term are somewhat barbelled. On one end, if the consumer remains stronger than expected and inflation kicks back up, the stock market would likely experience some dislocations, which would be driven by the market shifting its expectations that the Fed would no longer be able to cut interest rates further. On the other end of the spectrum, stocks would likely falter if employment data and consumer spending were to deteriorate more than expected. That would be due to the increased possibility of a hard recession and that the Fed waited too long to decrease interest rates.
More Trump tariffs.
China vowing to retaliate as necessary after President Trump announced the U.S. would hike tariffs another 10% starting March 4th.
President Donald Trump has made it clear that trade tariffs are a cornerstone of his economic policy. That included U.S. tariffs on commodities like steel and aluminum imports. In his second term, Trump said he would push 25% tariffs against Canada and Mexico, along with an additional 10% tariff on China imports. In January, he issued temporary tariffs against Colombia for not accepting deportees. Once the South American country changed its mind, the Trump administration rescinded the tariff, but it appears that's a club that the White House will wield if global governments don't play ball. President Trump's potential policies, higher tariffs, tax cuts, and immigration restrictions, add further uncertainty, with implications for inflation, trade, and fiscal sustainability. That's a wrap, Wealth Tubers. We've covered 8 major risk factors that could impact the stock market in 2025. Do you think a crash is coming, or will the market power through? Drop your thoughts in the comments. If you found this video helpful, don't forget to hit that like button and share it with others. And of course, subscribe, and I'll see you in the next one.